Hi, and welcome to Macro Monday, where we talk macro, trying to make sense of markets that they don't really make any sense. And more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today as we try to figure out, is there a V-shaped recovery in the services sector? Well, today we're going to dig into the data and help you understand it better. But when we talk about trying to make sense of markets that, don't really make any sense, here's a perfect example. Over the weekend, one of the large banks came out with a report that says they're bullish on stocks because firing people means higher profit margins. Now remember, not long ago, it was, hey, look, rising payroll reports, companies are hiring, that's bullish for stocks. Oh, now they're firing them, that's bullish for stocks. Which is it? And that's why it's really hard for investors to make sense of this, because the simple answer is, I just buy stocks all the time and then you don't have to worry about being right or wrong about a payroll report. It seems really silly, but it's always important to ask when you're looking at a source, what are they selling? Are they pushing something? Is there an agenda? Are they a securities dealer? Then they have too much inventory. Why would they be telling people to buy stocks when employees are being laid off? Is it really going to be bullish for stocks? Are companies going to have massively high profits? Well, remember we looked at the import and export data on Friday, and the import data says, not so much, that profits fall along with imports. Well, let's dig into the data this week, or at least, of what we have of this week. Let's start with Sunday. Out of Hong Kong, the manufacturing PMI was virtually unchanged from the prior month. So no improvement in the Hong Kong manufacturing sector. As we look into this morning, we have construction PMI out of Great Britain showing a slight improvement over just decimation the month before. Just horrible at 28.9, massive contraction. And all this is saying is there was a slight improvement over last month. So no V-shaped recovery in the construction sector of Great Britain. Excuse me, how about retail sales on a year-to-year basis out of the Eurozone, minus 5.1% versus minus 19.6 the month before. So this is a nice improvement. It's still negative on a year-over-year basis, but at least it's not as terrible. So things have gotten a little bit better in the Eurozone as far as retail sales go. Now let's get, before we get into the U.S. data, there's something I forgot to tell you. There's a surprise ending today. In fact, it's such a surprise, I'm not even sure how it is. I know, you're like, I thought you were the host. I know, that's what's really crazy about it. Stay tuned. Okay, let's get into the U.S. data. So there's two companies that put out manufacturing and services data. One is Markit, M-A-R-K-I-T, and the other is ISM. Now, the ISM is considered the gold standard. They are not a government agency, but they're considered the gold standard. Markit releases early. So let's see. In June, they said the services PMI came in at 47.9, which is a very, very slight contraction. We could almost say flat over the prior month. And the prior month was pretty bad at 37.5. So what they're saying, at least what Markit's data is saying, is there was no improvement. In fact, things might have gotten slightly worse than last month. Now they have a composite PMI, which is both manufacturing and services. It printed at 47.9 for June. The prior month was 37. So what it's saying is, things really didn't get any better from May. They're still bad. And that's interesting because as we look to see, is there a V-shaped recovery in the services sector, according to Markit, the answer is no. Let's get into the ISM data. Now, it came out, the non-manufacturing or services PMI for June at 57.1. Now, remember, anything over 50 is an expansion, and how far over 50 determines how expansionary it is. So if this number was in the 70s, it would say, wow, there's a lot of expansion from the prior month. Remember, this is a month over month. So at 57, it says, hey, this is, there's an expansion here. There's an potential improvement. So from a headline number, you would see this at 57.1 go, wow, the services sector in the U.S. made a rebound because the prior month it was at 45, which is, say slight contraction. So this would be good, meaning that things are better than they were last month. Now let's zoom into the June data and go back and see, okay, back in May, the services sector was bad. It contracted at 41.8. The next month, it had a slight contraction, and this month, had, say, a modest expansion. So does that mean the services sector, according to the ISM, is back to normal? No, does not mean that at all. Let's dig under the covers, because if you just look at the headline number, it doesn't tell you everything. And what I want to do here is, from a macro perspective, and you don't have to agree with me. This show isn't about agree with Steve. It's not called that. It's about understanding macro, and your opinion may differ than mine, which is great because that's how the markets work. But I want you to look at the data underneath and then make your own opinion. I'm going to share with you my opinion, but I want you to be thinking about what your opinion is and how I look at the data versus how you might look at it. So as we look at the components, that we have the non-manufacturing or services business activity, and it's printed a 66. Now that's pretty healthy in terms of expansion. In the prior month, it was at 41. Now, what is business activity? Well, when your business is shut down, any activity's got to be better than next to nothing. So this is showing that businesses were more active in June. What a surprise. They were just started coming back online, say mid-May. And remember, in May, it was at 41. Let's zoom into this data and see. Now, look back in early May. It printed at 26, effectively saying the economy was completely shut down. And then the next report said, hey, this was a flash report. No, this was the next month report. Said, hey, it got slightly worse than really bad. And this month, it said, oh, things expanded, meaning it's not back to normal. It's just an improvement over really bad, maybe too bad. That's how you would interpret that. So business activity is bad. Now let's move on to, I mean, does that make sense? It does, because businesses are reopening. But are they reopening with the same amount of hours, same amount of customers? No, they're under reduced conditions. So they are more active, but nowhere near where they were. So that makes sense. Now let's go into new orders, because remember, new orders are really critical. And wow, they posted a 61.6 versus a 41.9. So that might say that, hey, new orders are getting back to normal. Well, let's dig into the data again. And back in May, they were obliterated down to 32.9. So that means there were hardly any new. In fact, new orders contracted so bad, there was pretty much none. And then the next month, well, they still contracted, but not as bad. And now they shot up. So are new orders back to normal? Not even close. And does that make sense? Yeah. Businesses weren't able to order things, so they did run down some of their supply. So they need to increase orders on the things they're selling. So it makes sense. Is it back to the way things used to be? Not even close. I mean, go down and look at stores. They have vacant shelves. They have stuff that's not being refilled because there's no demand. So this tells us, okay, that makes sense. So new orders have improved, but still not back to where they were. How about prices? Well, prices went from slight expansion to, wow, they expanded. Prices went up. Well, that's got to be inflationary. No. Look, what is inflation with prices? Does it mean that anytime prices rise, that's inflation? No. You know, what if, say, a car manufacturer raises a price? Is it doing it because its input prices went up? Is it doing it because of demand? Why is it doing it? So inflation comes when there's so much demand from newly printed money that businesses are forced to raise their prices. That's where you really see inflation coming from. This is not inflation. And the reason it's not is because if you've been to anywhere lately, what do you notice about their prices? Well, you go, well, they went up. Why? Do you ask why? Why? Well, you notice their employees might be wearing masks. Well, that costs money. Maybe there's no cleaning protocols that the places have to do. That costs money. So the cleaning supplies cost money. New signage, perhaps new menus, new advertising, new hours. All this stuff costs money. Employee training to deal with all the new protocols. So are prices rising in the service sector? Yes. Is that interpreted inflationary? No. So if we look at prices, we notice that really they were at 50, went up slightly, and are going up. Does that make perfect sense? It makes perfect sense to me. So I don't see rising prices as a boom for the services sector. I actually think that's a negative as fiscal stimulus looks to roll off. Now let's go look at employment. And here we have in June, 43.1. How do you interpret that? Well, that means businesses had less employees. And the month before, 31.8 was bad. It means they got rid of employees, and now they've got rid of some more. And we can zoom in on this if we want to and see that, wow, going back to May, they got rid of employees, got rid of more employees the next month, and, well, guess what? They're still getting rid of employees. So what does that tell us is going on with the services sector? Businesses are reopened. They're not reopened at their former capacity. They're not reopened at their former inventory levels. They're not reopened with their same employment levels, and they're forced to raise their prices. So they're doing more with less, trying to get by. So do I interpret this report as bullish for the services sector? No, it tells me the services sector is still in big, big trouble. Now, how you interpret it, up to you, but I wanted you to go through and read into how those subsectors are calculated and what they kind of mean to you. Now, going into the data you can look at tonight, there's some data coming out of Japan. It's some of its May data tomorrow. The Red Book retail sales should be interesting, and then we have the Joel survey, and we'll pick all that up on Wednesday. Now, also the Hedgeopia data, because the market was closed on Friday, we'll pick that up on Wednesday too as well. So let's take some time now and look through some charts, because I really wanted to do this on Friday, but we kind of ran out of time. We'll take some of your questions, and then we'll have the surprise ending. As eager as I am to see what it is too, you will hopefully be as well. All right, so we've got this trend line on the S&P 500, a constructive move. It bounced off its 200-day moving average. It had buyers here at the 200-day, buyers at the 200-day, and buyers again at the 200-day. So this is constructive when it's moving higher. Now, what does it mean the S&P is going to take off and break all-time highs? It might, I don't know, but for the moment, this is a constructive move that bulls are wanting to push prices higher. How about the Russell 2000, the small caps? What do we see here? It's on a rising trend line as well, but small caps, remember, lead large caps, and right now small caps keep finding sellers pretty consistently right around this 1445 level. There's kind of a major level of support down here at 1350-ish, and of course that trend line that could see selling all the way back down to the March lows. How about volatility? Now, interesting that volatility held its 200-day moving average back in early June, and once again, this is not something that the equity bulls want to see. They want to see the VIX down here, maybe in the mid-teens. They don't want to see it up here, and they certainly don't want to see it finding support at the 200-day moving average. And the risk for the VIX is it gets back over this 31-ish, low 31 level, and takes off from there. How about Treasury yields? 5-year Treasury yields pretty much hugging this trend line. Briefly broke through. Sellers pushed it back up, and again, it's looking like it's going to make another attempt to break lower. It should, of course, with the Fed doing all of its QE. How about the 10-year Treasury yields? They crossed below their trend line and have gone up and reconfirmed it 1, 2, 3 times and are still below its 50-day moving average. That is a bearish picture for 10-year Treasury yields. How about 30-year yields? Kind of same picture here, different moving averages. It broke through its trend line, came back up, retouched it once, twice, 3 times, and is closed below its 100-day moving average, this darker blue line, 1, 2, 3 times in a row after attempting in early trading today to get over that 100-day moving average. Again, this is a bearish backdrop for yields. And let's take a look at the long bond, TLT, which is effectively the opposite of 30-year Treasury yields, and we've seen it pretty much consistently. Buyers are stepping in right in this zone here. I can almost move this dark purple line down, but I'm going to kind of leave it where it's at. It's holding its 100-day moving average as we would expect, and it's holding the top end of this trend line, which is notable because if we zoom out just a little bit to a similar pattern that was much longer, when it crossed out of that line, it got rejected and pushed almost back down to the top of it, and then it took off and just squeezed all these short sellers out. Well, look what's happened here. It crossed over, it's coming back, reconfirming the bottom of this trend line. We're seeing some buying, definite strong buying in here. The only question is, will it shoot higher and squeeze all these shorts out, or will the sellers hold? So the sellers are desperate because remember, it came into this sell zone up here. Here we have buyers down here in this what looks like a road, and up here in this road, you have 2 lines with dots down the middle. This is what's called a sell zone. This is where sellers have been selling. Down here is where buyers have been buying, and sellers are trying to push yields up. It's a foolish move over the long term because it's really these interest rates are constricting credit, but you have the Fed and large commercial banks and possibly even foreign central banks, we don't know yet, we won't know till well after the fact, buying treasuries here, putting upward pressure on prices, and all they have to do is start squeezing out these shorts, and you've got the next leg of what probably will be the final leg of the big bull market here in treasuries. There may be a little more. I mean, there probably will be a little more, but this will be a pretty big move in itself. How about the energy sector? It's flirting with its trend line here and looking to potentially break lower as it holds below its 100-day moving average. So the energy sector needs some good news. And the good news it's looking for this week and next week is the oil inventory data. And I don't specifically mean this week's data, although it will be important. These are big driving seasons, big travel seasons, and with airplanes pretty much not flying for the most part, you're not going to see big distillate draws. So the oil industry is dying, maybe literally, but desperate for massive, massive crude and product draws. Because if they don't get it, then this week and next week, well, we're a couple weeks out from school starting back up, and that's when people generally wind down their travel season. So what we see in this chart tells us that the big buyers in the energy space are not bullish. In fact, if this topping pattern holds out, you're going to potentially see a revisit or break below the March lows there. How about the financial sector? It's sitting right on its trend line too. Remember, the banks are now not allowed to buy their stock back for this quarter. That puts upward pressure on bond prices, downward pressure on financial stocks. And of course, we've seen the big banks buying their shares, or not buying their shares back, stop buying their shares and buying more treasury securities. So similar to the energy sector chart, closing below its 100-day moving average, looking potentially to break below this trend line and squeeze these buyers out. Emerging markets popped today. This is pretty interesting considering China told people it should start buying stocks. It didn't work out the last time they did that, but again, there's your rising trend line. Will this hold and go? I'm not sure, but silver is really not confirming any of that, and usually silver follows this higher. In fact, where is silver? Well, pretty much back where it was in 2008. Yep. Back where it was in 2008. Remember, silver rallied up with gold. So if you think gold's going to take off all the way to the moon, well, there's a lot more upside in silver than there is gold. Or what that tells you is that gold is in a speculative bubble here and is due to come back down. One of the two things is going to happen. How about the dollar? And it's worth taking a look here because it's following a very technical pattern. Remember, it came out of the supply zone. These were buyers at. This zone up here is where the seller's at. So seller said, nah, you're not getting in here. Sell down. The buyer said, no, we're good. We'll buy. Seller said, nope, we're not letting you in. Came back down, and buyers right on top of the buy zone, suggesting that the next move for the dollar is to make another knock on the door up here unless sellers can push through. So that'd be pretty interesting to watch how that plays out. Remember, a bullish dollar is also bullish for the bond market and bearish for equity. So stock bulls want to see this go lower. Bond bulls certainly want to see this go higher. All right, now let's jump into some of your questions. See where we go, and then we'll have the surprise ending. I would first like to say I really appreciate all of the content you are giving out. It is a wealth of knowledge, and you are something of a celebrity in my household. Hey, how cool is that? I mean, that's, wow. 00 Steven, bonds, trades bonds. Look, I finally get it. Even my wife got it, and I didn't get it. So there you go. I've been meaning to say that. That's probably a terrible spot to say that. But anyways, well, it's cool that I'm a celebrity in your household because we found your channel a few weeks ago and been watching the video day to try to learn as much as we can. Cool. I have a couple questions for you and hope you could answer whenever you have time. Well, I think now's as good as any. I have picked up bits and pieces of your deflationary thesis throughout the recent videos I've been watching. However, is there a video in the past where you could point me to specifically where you lay out your entire thesis point by point, or have you always been explaining portions of it during every video? I believe I've been explaining it piece by piece. That's the best of my knowledge. It seems like we're just building blocks here. It's possible I've done a video in the past where I've gone through the bigger picture of it. I don't remember when or what. Sorry about that. I have no economics, finance background. I'm a dentist by profession. Cool. Dentists are dentists are big savers and big investors. So this is cool that you're watching this. But would like to learn a lot more about macro. Are there any books or materials that you would recommend for listeners as a good beginner's guide for macro trends and topics? And the answer is no, I actually don't. I don't have any macro books that I've read. A lot of this has just been trying to interpret the data. There's been a number of subscription services I've signed up for. Try to watch videos and read reports. Again, some of it's subscription, some of it not. Just trying to understand and building my macro picture together. Obviously my view is different than plenty of other people, but unfortunately, no, there isn't any one book, or in fact, I can't think of any book I've read on macro specifically that would help you. So apologize for that. Wish I had something for you. I know it's impossible to accurately predict the next leg down in the stock market. You got that right. But are there very specific indicators that we can all look out for that will guide us to knowing that something's around the corner? I remember one video stated if the dollar reaches around 103. Yeah, if the dollar gets over 98, things are going to start to unwind. Probably watch treasury yields. That's usually what I'm looking for, is if I see treasury yields start to break down and fall. Where's my... Well, guess where that means stocks are going to go, and where's the dollar going to go? You got it. So it's I'm really focused on the treasury yield market because it's going to squeeze all these people out, and it's going to be interesting. Thanks for all your time and effort. Hey, you're very welcome. P.S. I picked up bits and... Oh, yes, okay. I've only picked up bits and pieces about what the VIX story could entail, but I'm hoping it's something ridiculously epic, like how you put 100,000 into TVIX in March and rode that thing to 1,000 and cashed out. Can't wait to hear it. All right, well, if you think it has anything to do with TVIX, I apologize now. You're going to be sorely disappointed it doesn't. Now, I didn't really know what TVIX was until some of you have mentioned it in the comments. Look, TVIX is dumb, and I'm glad it's being closed because you should not touch it. In fact, I'll just say this. As someone who's traded volatility and knows how dumb it is, TVIX is dumb on top of dumb, and I'm qualified to say that. So, yeah, no. In fact, if I did what this person said, that would have turned 100,000 into 2.5 million. If that's the story you're looking for, sorry, it's not that grandiose. It's cool, but, I mean, in terms of 100 to 2.5 million, no. If my story, if it would have been in TVIX, that would have been about $25 million or so. Yeah, I might quit doing videos at that point. Yeah, someday we'll get the story. Isn't deflation necessary for the economic recovery to start? I think it is. In fact, I'm pretty much betting on that. By that, I mainly mean falling consumer prices. Yes. The consumer needs to buy stuff, and the stuff doesn't get cheaper while the labor market is in shambles. Many people won't buy stuff. Hey, what an idea. People are losing their jobs, so they have less income, and they need prices to fall. Hey, you got it. That's market doesn't get it. The Fed doesn't get it, but you got it. That's you got it exactly. Many people are permabulls on tech companies like Facebook, Alphabet, Google, Microsoft, because they're the future. Their monstrous market caps and dominance of their daily lives in the last year seem to be strong arguments to be a permabull in FANG stocks. What do you think about this? Well, what I think about it is I grew up during the tech bubble, and I invested during the tech bubble, and I want to show you something, because the tech bubble was just like this. And we're going to go to the Invesco website, pull up QQQ. You can look up portfolio, and you can look. Apple, 11% almost 12% of the index. Microsoft, almost 12%. Amazon, almost 11%. Facebook, 4%. Alphabet, 2 different share classes, 7.5%-ish, 7.25%. Look, when you have an index that has like almost 50% weighting in 5 companies, yeah, it's bubble. What the market is saying is that these companies not only are going to be 50% of this, they're going to be more. They're going to just continue to get bigger and bigger and bigger. And this is exactly what happened in the peak of the dot-com bubble. You had a small number of companies that were the biggest. Cisco was going to dominate the world, and well, it's still a great company. I've used their products. I don't own any now that I know, but nevertheless, when I worked in the IT industry, I loved Cisco products. Surely enough, they are not like they once were. And that's what happens with what's called market cap weighting. Is a lot of money gets concentrated in a small number of stocks. And so now what happens is not only is the U.S. economy tied to 5 companies, but the wealth of pretty much every American who's invested in the market is tied to 5 companies. And so these 5 companies forever need to be big and dominant. And as history says, that's not going to happen. And this is why I say that, and I'm not the only one who said this, but when markets eventually deflate, what happens when everyone's selling the 5 same company stock? Well, are there any buyers for them? And that's why you see these massive, just sharp bear market plunging in stocks, because everyone owns the same thing. You know, people that own QQQ that are not hedged or in some other form are not diversified. They own 5 companies. You know, half their money's in 5 companies. It's a lot of risk. We need these companies to indefinitely do better. Yeah, not likely. So I don't buy into that thesis because I've lived through it. Also been wondering why the Fed wants to buy bonds from companies like Apple, Microsoft, Daimler, BMW, Volkswagen. Some of those companies aren't even American, and Apple has the biggest amount of cash in the world. In fact, Apple could pay off all its debt and still have tons of money, tens of billions of dollars. This doesn't seem like a bailout. Why would the Fed buy those bonds? Do they want to let those bonds mature and make a profit off of them, or has the corporate bond market dried out so much that the Fed has become desperate? So here's the deal. I can't explain why the Fed is buying specific companies. All I can tell you is generically they're trying to lower interest rates. That is the purpose of the Fed buying up the bonds. That's it. This to get corporate rates down. That is the whole purpose of it. Whether or not any of us agree that they should be buying, say, Apple bonds, who doesn't need the Fed to buy them or not, or they're buying, say, VW, foreign company bonds. Look, I get it. All I can tell you is the Fed buys bonds to lower interest rates. Now, according to what I can find from the Fed, they're claiming they're doing it to create a broad index and blah, 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 whatever. But the reason is to lower interest rates. Thanks again, and get those bonds, bongs, and bongs. Both seem to be good. Yeah, no doubt. All right, to make sure I understand your thesis, a bunch of people have borrowed bonds and sold them and then signed a contract saying they will buy those bonds in the future to pay back the bonds they borrowed. Yes. After these guys sold their bonds, but before they bought more, the Fed bought a ton of bonds, which drove up the prices. Yep. You got it. So now all these people have to buy bonds in the future in trouble because they are more expensive than they expected. To pay for the loss, they must sell stocks. Now understand this. Let's pause here for a second. They're expecting bond prices to do what? Go down. They're betting on interest rates going up. That's what they're betting on. My take is just like the great financial crisis, with the Fed gobbling up the bond supply, they're going to be wrong and on the wrong side of the trade. Hence, you get a massive short squeeze in the bond market, and you get a collapse in stock prices as they've got to unwind all their risk assets. It's exactly what happened before. So this effect feeds on itself in a death spiral, driving up the price of bonds and driving down the price of stocks. Pretty much that's exactly what happened in the great financial crisis. My question is this: can we take a look at the people who borrowed and sold bonds? No. We know that there's hedge funds and other speculators, but we do not have access to any information on who they are and how much they've sold, and we need to buy bonds in the future. There's some information out there, but not that much. Who are these people? They're people that are betting on higher interest rates. How many are there? Don't know. And why would they borrow bonds today and sell them and then put themselves in a situation where they're contractually obligated to buy bonds in the future? Simple. They think interest rates are going up. It's like saying, hey, they can't go any lower. They can, but that's what they're betting on. They're betting on interest rates going up, and I believe they will be wrong. Very, very wrong. I'm so grateful for your videos. Thank you. Hey, I am grateful for you for being a fan of the show. All right, so now we got a couple minutes left. All right, so what is the surprise? Well, a box showed up at my office with something in it. I'm going to read you the note. I have not opened it. My wife said, no, you should open it on the show. She goes, that's what the cool content producers do. Okay, got it. Yeah, I want to be cool here. All right. Dear Steven, as a token of my appreciation, I highly recommend this book. If you're interested in an easy, understandable explanation of crypto, thank you and greetings from Long Beach. Well, from Marcus. Well, hey, thanks, Marcus. So it is a book, I can tell. Now, if this is Cryptos for Dummies, I am totally going to laugh. That would be hilarious. So let's see. I have no idea. I did not open it at all. So we'll see. See, I told you, still wrapped up in his paper. And what do we have? Cryptocurrencies by Dr. Julian Haas. Well, Marcus, I really appreciate you, and I appreciate you sending this to me, and I will certainly enjoy this book, and I appreciate all of you for taking the time to watch. I hope you learned something today, and I'll see you on Wednesday, where we get into whatever the Wednesday data and whatever other stuff it brings us in the macro world. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation to buy or sell a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre in our own personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial.